What history teaches us about markets like this. Hang on, folks. This is a long one. Ultimately, investor sentiment, how buyers and sellers of securities feel, is what determines prices and profits. Bull markets and bear markets. It really is all about how we feel, since this determines what we do. What we do determines what stocks do. It's really that simple. There's an old saying in the investments business, stocks are the only thing no one wants to buy when they go on sale. While the fire sale prices on stocks we alerted you to a couple of years ago are mostly gone, stocks still represent enormous opportunity and have a long way to go, in our opinion. It has been so long that it's hard to remember, but the market peaked nearly 4 years ago and is still down some 22% from the high as I write this in early October. Moreover, the 2000s bear market, which began in March of 2000, now over a decade ago, is nearly as old as the worst periods of the 20th century, and has been the most vicious in terms of annual percentage decline since the Great Depression, and more than twice as bad as the endless bear markets of the 60s and 70s. Such enduring bad periods tend to depress investors' psyches and remap their risk-reward behavior circuits for a long time indeed. If we're like most investors, you think very differently now and are much more sensitive to risks than you were a few years ago. This can be both healthy and dangerous. As we have noted in the past, this is a good news for the stalwart, but bad for the average bear who winds up coloring decisions against his or her long-term financial interest. Well, unfortunate, this is classic behavioral inertia. When things are good for a long stretch, we expect them to continue so. Real estate prices can only go up, was a popular mantra just a few years ago. And when bad news persists, the natural reaction is to expect continued gloom. This war will never end. It always rains, and everyone knows the stock market's going to zero, or at least back to 6,000. But extrapolations are clearly false when run through the forebrain. The trick and the hallmark of superior investing is to do this kind of thinking before the fact. The great bull markets of the 20s, late 30s through mid-1960s, and mid-70s through 2000 are as much of an example as this as the great real estate-led meltdown of the 2000s. This is something to think of as investment fashion, and it's clear that real investments, as opposed to the guaranteed decay of bank accounts, bonds, annuities, and the like in low-interest environments, like stocks, will be out of fashion for a while despite the spectacular 2009 rally and fairly firm pricing since. Average investors got whacked so long and hard in the meltdown that they will base decisions on this behavior modification experience for a long time to come, likely at their peril. Even once the trend is clearly shifted and things are going up again, they may falsely extrapolate the old trend because that's what their guts tell them to do. When they finally jump totally back in, it'll be after a long period with immediate trumpets to continuing upward trend, and their guts have been reprogrammed yet again. Sadly, by then, a lot of the gains that that we're expecting will have been booked, and the market may again be headed toward overvaluation. The average bear's sentiment changes only very slowly, become the average bull after only a long period of watching gains in which they do not participate. These tend to be the same folks that get out near the bottom after watching the drumbeats of doom on TV for months before finally throwing in the towel. They will sit in the sidelines of cash for months or years, watching the good news gather in the recovering stock market bud and blossom before finally getting comfortable that stocks are good again after missing much, if not all, of the gain, and who wind up buying what they used to own, but paying far more than they sold the stuff for on the last go-around. It'll take longer this time for these folks to forget their sins fingers, and that may cost them even more. Bad for them, but good, we hope, for you. The next few years, we believe, will present a tremendous opportunity for the wise to accumulate quality assets at historically low prices. Whatever you feel about Buffett the Great, and I use that term guardingly in light of the Buffett rule, the fact that he is even buying his own stock back says something about how cheap things have become. Think about that. When the payoff comes, it should be jackpot time for those who carefully built prudent portfolios, overcoming their natural emotional tendencies, using discipline and intellect to rein smarter than the average bear behavior back in where it belongs. To put things in perspective, you're not going to believe this, but to put things in perspective, if we get the same upside this time as from the secular 1970s low to the 2000 peak, the Dow should melt 150,000, currently at about, what, just under 11,000 here in mid-October, 150,000 from the March of '09 lows to next peak. And there are many good reasons to expect an even bigger swing this time, in my opinion. If we use the 30s as a projection baseline, the next secular peak is pushing 110,000 on the Dow. I know you don't believe this. You won't believe it now. It sounds like pie in the sky. What has Camarda been smoking again? But just think how impossible a Dow of 14,000, which we hit in 2007, just about 4 years ago, would have seen back in the 70s when the Dow was at 600s. And it was struggling to break 1,000, or even in the early 90s when breaking 2,000 was such a big deal. Nonetheless, it did and will happen again, I'm quite certain. Clearly, if history is any guide, there is a lot to look forward to, look at, and think as we contemplate the beginnings of what I think will be one of the next great multi-decade bull markets. Thank you so much for listening so long this time. I'm Jeff Camarda. Bye-bye.